Shira Kalfa, and today I'd like to talk about the 3 different tax accounts of a corporation. Now, a corporation can have all 3 or can have only 1, it depends, but most businesses have all 3, and I'll explain why. The RC account. An RC account is automatically assigned when we incorporate a corporation. An RC account correlates to the corporation's income taxes. Now, a corporation only has 3 rates of tax, unlike an individual, which captures a marginal rate of tax, which means it's a different rate depending on the margin that you fall into. So, they like to make it nice and simple. I say that jokingly for individuals, but it's not. But a corporation has basically a flat tax. There's 3 different rates. There's 12.2% if you're subject to the small business deduction. There's 26.5% if you're not, and we're talking about active income. And then there's 50.2%, which is the passive income. So rent, interest, dividends, royalties capture this passive income rate. There are some other rates, but those are basically your 3 standard rates of a corporation. So what does that mean? So a corporation, all of the revenue that it generates triggers tax inside of a corporation because it's its own separate legal entity. And so the RC account correlates to that income tax. Every corporation is going to have an RC account. In fact, it's automatically assigned and opened once we incorporate a company. The number is the corporation's BIN. Now, a BIN is a federal tax ID that has various different suffixes. So your tax ID is going to be 9 digits long, but then it's going to say RC0001. That means that it's this corporation, because it's this tax ID, and this tax account, which is its general income tax. In contradistinction, there's an HST account, which is called an RT account, and a payroll account, which is called an RP account. Now, these are optional. These aren't automatically assigned when you incorporate a company. The RT account correlates to HST. So if the business registers for HST, now its HST number is the 9-digit BIN plus RT0001. That means it's the first program account of its HST account. Now, HST, for those of you watching in Ontario, it's 13% harmonized. And every business that exceeds $30,000 of gross income worldwide has to register for HST unless you deal in exempt supplies. So, for example, medical supplies and certain other goods are exempt. But most businesses will have to register for HST, and then they get their HST account. So that's the RT account. RP is for payroll, and again, here you only want to open a payroll account if you have employees. And so a lot of new businesses, when we incorporate, they say, oh, well, should I open an RP account? How do I pay myself? Do I have employees? Or you know what? They say, no, we don't need one. We don't have any employees. Well, you do. You have yourself. How are you going to pay yourself? As a business owner, there's only 2 ways to extract funds from a corporation. You can pay yourself salary. You can pay yourself dividends. And so if you pay yourself salary, you need an RP account. You're going to be taking source deductions. You're going to have to pay income tax and CPP and EI, and you need that program account in order to do that. And so that's the RP account. One thing that I want to talk about more is whether you need both these accounts, the RT and the RP, on incorporation. HST. So we get this question a lot. Do I register for HST now or later? As I mentioned, the rule is you must register for HST when you hit $30,000 of gross revenue in worldwide sales in a fiscal year. And so a lot of people say, oh yeah, well, I intend to hit that in 6 months, but not now. Do I register now? Well, yes and no. Let's talk about it. If you register now, then you're an HST registrant. You've elected to register prior to it being obligatory to you. And therefore, you have to charge 13% on all of your goods and services to your customers. So in that sense, it's a burden to your customers that they're paying for something they wouldn't have to otherwise if you hadn't voluntarily registered before you hit the threshold, right? But at the same time, now that you're a registrant, the Itc credit system is available to you. So Itc stands for Input Tax Credits. And an input tax credit is a credit that a business receives for all of the HST that it pays in the operation of its business. So prime example is commercial rent is subject to HST. It's exigible, as we say. And so that 13% that you pay on your $6,000 monthly commercial rent, you will get back only if you are an HST registrant. If you're in the business of the purchase and sale of goods, all of the goods that you purchase, you're paying HST on. And then you resell them. The whole reason for the ITC system is to prevent double taxation. If you are a registrant, then when you resell those goods, all of the HST that you paid in the acquisition of those goods is applied towards the HST that you've collected, and you actually, you only have to remit the difference. So what that means is you get some of your HST back. You cannot get some of your HST, or basically all of the HST that you incur in the operation of your business, you cannot get it back if you're not a registrant. So that's kind of what I assess with my clients at the outset. I say, okay, well, you know, if we register now, we have access to the ITC system. Let's talk about your expenses. Are you taking on commercial rent? No. Are you dealing in goods? No. This is a services business out of my home. Well, you're probably not incurring a lot of HST, so it probably doesn't make sense to register for HST voluntarily and have to pass on that obligation to your client without receiving a corresponding benefit. So that's kind of the analysis there. With respect to payroll, I kind of touched on it. The issue with both payroll and HST is that once you apply for these program accounts, now you have a headache, because now you have an obligation to file certain returns and remittances. With respect to HST, it's either monthly, quarterly, or annually, and with respect to payroll, it's monthly. Once you register, you have to file, whether or not you collect, whether or not you're remitting, and so that's a headache. Even if it's a nil remittance, right, you put zeros there, that's a headache. So that's a consideration with respect to both of those program accounts. With respect to the RP account, which is the payroll account, if you intend to pay yourself, then yeah, go ahead and open it right away. But a lot of businesses say, you know, we're just starting up now, we intend to have our first employees in 6 months from now, then we actually don't open the RP program account when we incorporate, because I don't want to create a burden and a headache for my client for the next 6 months to have to file nil remittances on the 15th of each month for 6 months for no reason. We'll open it then. So those are kind of the assessments and the analysis that we go through as corporate lawyers at our firm to determine when to open the latter two program accounts, RT and RP. As I said, RC is automatically opened when we incorporate a company. And that also gives you some explanation as to what's the difference between these program accounts and how do they work.